Hello, this is Elizabeth Garrity here with Burkenroad Report's continuing coverage of SEACOR Holdings Incorporated, Spring 2012. We forecast that SEACOR's 12-month target price will rise to $103 from its price of $95.07 on April 9, 2012, giving the company a rating of market perform. Founded in 1989, SEACOR Holdings is a diversified, multinational company that owns and operates marine and aviation assets, primarily servicing the oil and gas, industrial aviation, and marine transportation industries. SEACOR also owns and operates bulk commodity barges along the U.S. inland river waterways and provides crisis and emergency management solutions to governments and industry. The company is headquartered in Fort Lauderdale, Florida, but operates internationally in over 30 countries, employing 5,000 people worldwide. SEACOR has a market cap of $2 billion, and 2011 revenue was $2.1 billion. SEACOR's business is divided into 7 business segments. The company's Offshore Marine Services business segment provides support mainly to offshore oil and gas exploration companies. SEACOR's Aviation Services business segment operates a fleet of helicopters used primarily for providing services to offshore oil and gas companies in the Gulf of Mexico and Alaska. The Inland River Services business segment owns and operates inland river transportation equipment in several rivers in the United States and in the Gulf Intercoastal waterways. SEACOR's Marine Transportation Services business segment provides marine transportation services for petroleum products and chemicals in the United States. The company's Emergency and Crisis Management Services business segment provides response strategies and consulting services to emergency response companies. SEACOR's Commodity Trading and Logistics business segment purchases, stores, transports, and sells agricultural and energy commodities. Finally, SEACOR's Harbor and Offshore Towing Services business segment provides assistance in docking and undocking in port areas and harbors to LNG ships, petroleum and chemical tankers, dry bulk carriers, and container ships. SEACOR's largest segment as a percentage of revenue is its Commodity Trading and Logistics segment, accounting for 44% of the company's total revenues. The same segment was responsible for a negative 2% contribution to total profit. The majority of SEACOR's revenue is domestic, with U.S. operations accounting for 70% of the company's total revenue. Our investment thesis focuses on 4 main areas and their potential impact on SEACOR's future. Our first point focuses on the fact that, as of the date of this report, crude oil prices are high while natural gas prices are very low, both of which could impact SEACOR's business. Our next point focuses on SEACOR's sale of a significant portion of its Environmental Services business segment in the first quarter of 2012. Our next point is that SEACOR is likely to take advantage of low interest rates in 2012 by taking on new debt. Finally, our thesis focuses on SEACOR's continued investment in emerging markets, particularly in Brazil and Asia. Currently, crude oil prices are quite high, while natural gas prices recently hit an all-time low. A high crude oil price means that offshore wells that were once seen as unattractive are now more profitable, giving rise to increased rig counts and more potential business for SEACOR. The declining natural gas prices, however, could reduce the number of new gas rigs, potentially harming SEACOR's business. Overall, the drilling activities in the Gulf of Mexico have increased. In March of 2012, SEACOR closed the sale of a large portion of its Environmental Services business segment. SEACOR received $97 million for the sale of its National Response Corporation, National Response Corporation Environmental Services, SEACOR Response, Inc., and SEACOR Environmental Products. The company will maintain its ownership stake in O'Brien's Response, Link Associates, and Peer Systems, and the remaining businesses have been renamed as SEACOR's Emergency and Crisis Management Services. Interest rates are currently extremely low in the United States and will probably remain that way throughout 2012. SEACOR will most likely take advantage of these interest rates by taking on new debt to fund cheap expansion. SEACOR's debt-to-equity ratio for 2011 was slightly above the industry average and could potentially rise even further as the company acquires new debt. SEACOR is also exploring investments in emerging markets, and the Brazilian and Asian markets are particularly attractive. The company currently operates in Brazil and is likely to expand its Brazilian operations in the future. SEACOR is also currently involved in a joint venture in Eastern Asia and Australia, and the expansion of operations in China and India is also very likely. Our team used 3 valuation methods in determining a 12-month target price for SEACOR. The first method we used is the discounted cash flow model. This model produced a rather low target price, most likely because we were particularly conservative in our forecasting. We also produced 2 valuations using the multiple method, one using price to earnings and the other using price to book value. For these methods, we used the average of SEACOR's peers to get the multiple. We applied a reasonable weight to each method and came up with a target price of $103. In its operations, SEACOR mainly faces risks associated with unqualified labor abroad, strict and changing regulations, and high leverage. SEACOR's management expressed concerns about the availability of qualified human capital in labor markets of developing countries, especially in Brazil. Because of this labor shortage, SEACOR needs to train new international workers in the United States and other Western countries before they can contribute effectively to the company's goals. SEACOR also faces risks associated with legal regulations, both in the United States and abroad. Domestically, participants in the oil and gas industry have been subject to increased safety and certification requirements, as well as delayed approval of drilling applications in the Gulf. Subsequent increases in regulations could potentially increase the cost and decrease the availability of insurance coverage. An additional domestic concern relates to the Jones Act, which protects SEACOR's business segments engaging in U.S. coastwise trade from foreign competition. If the government appeals or amends the Jones Act, foreign companies and vessels will be allowed to enter the United States market. The entrance of foreign competition would undoubtedly hurt SEACOR's business, specifically its offshore marine services, marine transportation services, and inland river services business segments. Internationally, the company's ability to compete in foreign markets is heavily subject to foreign laws and regulations. Some countries may impose regulations that favor local competitors in the awarding of contracts. Such regulations would severely hinder SEACOR's ability to perform in these markets. SEACOR also faces risks associated with its high amount of leverage. SEACOR's debt-to-equity ratio, which was 58.20 in the fourth quarter of 2011, indicates that SEACOR relies more on debt than equity financing. This ratio is slightly higher than the industry average level of 50.90. And implies that SEACOR uses more debt than its peers. The interest coverage ratio is a measure of a company's ability to meet its interest expense based on its earnings before interest and taxes. SEACOR's December 2011 interest coverage ratio of 3.63 is close to the industry average of 3.71. This is a good indicator for the company's ability to cover interest payments using earnings before interest and taxes. For more information about SEACOR, please see our report at www.burkenroad.org, which contains most of the graphs you have seen, as well as additional information about SEACOR. Thank you for listening to our presentation.